Today we'll be talking about the market's optimism on the Fed put, something that we've seen for the past 30 years, but something that I don't think is happening anymore as the Fed continues its tightening policy. Today's topics, we'll talk about the Fed's mentality, we'll talk about the inflation outlook for US, then we'll talk about the US employment data that came out, US yield curve inversion, Bank of Japan, Blackstone liquidity concern, and also finally some targets. First up, we'll talk about Fed's mentality. If the Fed concedes, meaning it'll end raising rates, possibly signaling or actually cutting rates, and also stopping QT and also restarting QE, this would be a surrender to China on the financial war front, and they will not be able to continue pressure China as China's economies weaken from continue COVID shutdowns, even though now that we're seeing it being loosened, and also from previous financial bubbles popping from the tightening of the China Central Bank, as China Central Bank now is starting to loosen a little bit. And a lot of it Fed is pointing on in terms of its continuous tightening on employment data, where the Fed continues to stress how it will not consider reversing its tightening policy until employment data shows more weakness, significant weakness, meaning we need to see a lot more job losses, even though we're already seeing a lot of layoffs from a lot of the big tech companies, and the big reason for all these layoffs is because they mistook the 2021 growth in consumer consumption as an annual increase, but rather than what it is, which is a one-time impulse. And all that was because of the huge amount of money printing from the central bank and a lot of money spray coming from the US government in terms of stimulus bill. So a lot of people bought stuff that they normally wouldn't have, or they bought stuff a lot ahead. For example, a lot of people bought Pelotons or these in-house indoor exercising equipments. These are purchases they won't make probably for 5-10 years, but they were all done in that 1 year when they had a lot of extra cash. And what happens is all these companies thought, hey, this is something that can continue, and so they hired a lot of staff, they spent a lot of money, and now they're realizing, hey, our consumer is actually really weak. Because a company with inflation, their spending power has decreased significantly, and they can't buy as much as they were able to before. And because of that, that's why we're seeing a lot of job cuts. So in the next kind of event to see whether it kind of peek a little bit more into the Fed's mentality will be Powell speaking tomorrow in Sweden, and something that's hosted by the Sweden Central Bank. So that would be possibly a more volatile section, depending if Fed comes out continue hawkishness, or would he become more dovish. Now let's take a look at the inflation outlook. In my opinion, it will be difficult for inflation to come down significantly, meaning to the Fed's target of 2%. And because of that, that will at least give cover to the Fed to continue tightening for higher and longer. So obviously housing should contribute lower, even though the factor of housing in the CPI calculation is something called owner's equivalent rent, which is just bogus. They go out and ask people, hey, how much do you think you would charge for rent? And no one actually pays those rent, but it's just hypothetical numbers. But as housing prices continue to fall, we expect at least some sort of fall in terms of owner's equivalent rent, and that should help in terms of contributing a lower factor into the CPI number. But however, the problem here is potentially in the second half of this year we would see a commodities rally, And the reason for that is we continue to have the lack of long-term reinvestment in commodities extraction like oil and metals, and there's continued global geographic conflicts that will continue to make the supply chain not as simple as before. And because of that, I expect the commodities rally to continue in the second half of 2023. And in terms of the inflation year-over-year benchmark, even though housing as a factor should fall, but the problem is with commodities have fallen in 2022 Q4, if they rally, which I think they will, then that will be a positive factor contributing to a higher inflation number. So I don't think inflation will, be very high, exceeding, previous year's amounts, but I'm highly doubtful that it will fall to the 2% to what, the Fed is expecting inflation to fall down to, which then will help their hawkish narrative. Next up, we'll talk about the U.S. Employment data. So again, there's still tightness in the labor market, and this is continue from mainly the servicing sector. That is the sector that we're seeing a lot more continuous labor tightness, even though we're seeing, like I mentioned before, the high-end tech companies are firing a lot of people, but the problem is with the lower and servicing sector that is still tightness. And another thing is we're actually seeing manufacturing increase, which should increase as U.S. continues its goals to restart the U.S. manufacturing sector. Again, I talked about this before, bringing in, Taiwan Semiconductor when it comes to the semiconductor chip manufacturing sector, and also trying to draw industrial and manufacturing businesses from Europe, with Germany having to pay much higher price for energy. That is draw, and U.S. having U.S. LNG that will allow U.S. to take away and also produce things for a lot cheaper for that sector. And next up, for wages, we're seeing for higher skilled labor, it is more beneficial to leave to a new job, meaning if you're just staying with the same job, I think the number was like 7%, while if you were to leave your job to a different employer, you can see like a 14% increase. So what we're seeing is there's a lot of people jumping jobs because of that, which makes sense. Now let's take a look at the U.S. yield curve inversion. So for the U.S. Treasury yield curve inversion, it's widening from the short term to the long term, again 3 months to 10 years. And from a historic sense, this confirms that the recession is coming, because what happens is people are not confident in the U.S. economy, and therefore their willingness to take a longer duration is less, rather than 3 months. So that's why in terms of the yield curve inversion, that's why it's happening. But when it comes to equities from a historic sense, we need to see the shrinking of the Treasury yield spread, and that would potentially mark the last leg of the equity bear market. So I think right now what we're seeing is a lot of bear market rally before further down leg. I don't think in terms of trying to mark the equities bottom, I don't think we're there yet. Now let's talk about Bank of Japan. So Bank of Japan conducted emergency bond buying, the latest one being last Friday in January 6th. This comes after 2 rounds in December 28th and 29th. And what happens is the rates keep rising, and it's hitting their target cap. And in order to kind of bring the rates back down, they're going in printing more money to buying up more bonds, because when there's more purchases of the bonds, then the cost of it comes down, so the yields come down, and that's what they're trying to do. And this comes after Bank of Japan surprising the market by raising rates, in December 20th of their meeting, they raised rates from 0.25 to 0.5, but they mentioned they will commit to continue YCC, yield curve control, again, printing money to buy up bonds. Why is that happening? Because normally interest rates, when you're hiking rates, that would be a tightening policy, but for the quantitative side, they're still doing ICC, meaning they're still printing money, there's still quantitative easing, that kind of is counterintuitive to what they're doing in the interest rate front. And if Bank of Japan really cares about Japanese citizens as a nation, which has heavy domestic savers, Bank of Japan will allow rates to be much, much higher, because that way the domestic citizens can grow their wealth much easier with higher interest rates because they save a lot. But instead, Bank of Japan continues to keep rates low, and it's hurting domestic savers, and it's rewarding foreigners that borrow in Japanese yen. But what happens is the inflation rate is hurting local citizens, and to combat that, so it's raising rates, but it's still maintaining YCC. So Japan is pretty much compromising a little bit, be like, hey guys, I know inflation's hurting, but don't worry about me printing all this money. I'm raising rates to help relieve that inflation pressure. And obviously that's continuously hurting domestic citizens while helping foreign investors that borrow in yen, which is very sad. And the trade on the street right now is many hedge funds and more sophisticated investors are starting to short against what the BOJ is doing. They're betting against the Bank of Japan's efforts, and this will have severe implication when it comes to the bonds, stocks, and the Japanese yen, which I think bonds will continue. The bonds will continue to fall, meaning the yields will continue to rise. The yen will continuously falling, meaning it might have seen its peak for this year. So we'll see if that is the case. Next, let's talk about Blackstone's liquidity concerns. So University of California recently invested $4 billion into Blackstone's enlisted real estate income trust. And Blackstone themselves also committed $1 billion. And the interesting thing is there is a guarantee return of 11.25% until January 2028 for this additional investment from UFC of $4 billion. That's a very high guarantee return. And so the question is, why is Blackstone needing this liquidity injection, and why would UFC do it? Now, obviously, UFC, it makes sense, right? If you just take a look at surface, like, if someone's offering me, 11.25% guarantee return, I'm jumping on it. But when you require a high return, usually what that means is you're taking on a big risk because, no one's giving up free money here. And so you're in business. And, if you're willing to give up a high return, it must be a very risky business. And so Blackstone has been facing a lot of redemption liquidity issues, meaning they haven't been able to, satisfy all the redemption requests. They've been denying and stopping some of them. And it's likely due to, the real estate market continue falling. And so investors are pulling their money out of these real estate funds. On the UFC side, they have a lot of investment in Blackstone, and they're really on the same boat together. So meaning if Blackstone have issues with one fund, it could trickle to other funds and potentially take down the whole thing. And therefore UFC, who already have a lot of investment with Blackstone, doesn't want Blackstone to go bankrupt, to belly up, and therefore is putting in more money in order to keep them afloat, because they're on the same boat together. But given the risk of the investment, they're requiring a much higher return. And so effectively, the $1 billion that Blackstone has also committed is effectively collateral in case the 11.25% annual return is not met. So if the fund cannot return 11.25% to U of C, then Blackstone would have to carve out of its $1 billion to make up the difference on an annual basis. So as costly as it is, Blackstone is still willing to do it. That should provide a picture on how bad things must be in order on the liquidity end, in order for Blackstone to be like, hey, we're willing to do it, just give us the money, we don't care how costly it is, because we need the money. Finally, let's cover some targets. So for the US dollar index, so today we're looking at 103, just above 103. So it's falling today, 0.66%. And I'm expecting a slight bounce before continuing its further decline to sub 100. And based on that, I'm expecting gold to hit 17 to 1750 before a substantial rally. Same with silver, especially with silver when we take a look at today, where the US dollar is down, by 0.66. Not only did silver fail to follow rally with gold, a multi-month higher, silver is ending the day, negative. And so this further, confirms my thinking that gold and silver is a little bit overbought in the short run. So we need a nice set pullback before a substantial rally. And finally, with U.S. equities, once it breaks the 2022 June bottom, again, that is key. If it breaks it clearly, then I think the final leg of the bear market will unfold, and I think that should happen in the first half of this year. Thanks for watching.